Welcome. Accounting and Management Made Simple is your channel of choice where we break down complex and difficult accounting and management principles into simple, understandable concepts. Whether you are a student preparing yourself for exams or a professional looking to apply knowledge practically, this channel helps you to grasp and understand complex key topics with ease. Please subscribe, share, like, and comment. Thank you. Hello students. Once again, it's your Accounting Made Simple tutor, N Muchai. And today I want again to teach you something on theory. Remember, my philosophy for the 16 years I've been training young accountants is that theory can save a man. Theory can save a man. You need to be very, very serious with your theory. Most of the exams you find, theory is between 30 and 40%. 30 and 40%, even in computational exams. Financial accounting is not an exemption. And if you miss theory, if you fail to do well in theory, you will be reducing your chance to pass. And today, I'm introducing a topic called depreciation accounting. And we studied that in line with International Accounting Standard 16, which deals with the property, plant, and equipment. Accounting for property, plant, and equipment. You definitely need to realize that non-current assets are majorly of two types. We have tangible non-current assets, which we call property, plant, and equipment, and we have intangible non-current assets, which are not accounted for using this standard, and therefore the loss in value of intangible non-current assets is called amortization. And is accounted for with in line with the different international accounting standards. And therefore today we just want to concentrate on International Accounting Standard 16 that deals with depreciation accounting. And we are saying that depreciation is the loss of value of a tangible non-current assets. I'll teach three things. I'll teach actually two things. I have another video, our video called Capital and Revenue Expenditure. Please look for the video. Capital and Revenue Expenditure. That video introduces depreciation accounting. How do you determine the cost of a non-current asset? How do you arrive at the actual correct cost of a non-current asset? And we explained a lot. How to determine the cost of a non-current asset. The biggest assumption is the cost of a non-current asset is the purchase cost. That is wrong. The cost of a non-current asset is not the purchase cost. It is not the purchase cost. It is much more than the purchase cost. And the details about how to arrive at the value of the non-current asset, the value of the non-current asset to be captured in our books of accounts is very well explained in our video titled Capital and Revenue Expenditure. And therefore I'll be building on that video today. And today I'll be discussing about causes. What causes assets to depreciate? Again, at times we think that assets only depreciate by use, by wear and tear, because you are using it. But that is not true. There are very many causes of depreciation or loss in the value of an asset, and we're going to study them today. Then we are going to ask ourselves, what are the various methods of computing depreciation? What are the various methods of computing depreciations, and when are they supposed to be used? I've seen questions whereby you are being asked the types of the methods of depreciation, and then you are asked in which sectors are they supposed to be used. And if students do not have an answer, they know the methods, but they don't know how they are supposed to be used. So today I want us to start by saying that depreciation is the loss of value of a tangible non-current asset. Please mark that. Tangible non-current asset throughout its period of use by the firm. I've explained over and over again that buying a non-current asset in accounting is not an expense. Buying in accounting, there's a very big difference between capital expenditure and expenses. Capital expenditure is the act of buying. You have spent money to buy, but after you have bought, then some of the things that we buy, we use them and they get finished in the course of the year, and therefore they become expenses. But there are some assets we buy, that is especially the tangible non-current asset, and they stay for a number of years. So they are not expense until we have used them up in the farm and they are not there. The portion that we use in the farm is what we expense. That's what we take to the income statement as depreciation. But the portion which is not used, we retain it in the balance sheet as the net book value, the original purchase cost minus depreciation. Therefore, we are saying if depreciation is the loss of value of a tangible non-current asset throughout its period of use by the farm. Throughout its period of use by the farm. Remember that intangible non-current assets, intangible, the ones you cannot touch, they are amortized and not depreciated. We do not talk about depreciation of intangible non-current assets. For example, things like copyrights, things like goodwill. We do not talk about depreciation, we talk about amortization, and we have a different standard for that. So IAS16 on property, plant, and equipment, IAS16 on property, plant, and equipment defines depreciation as the allocation of a depreciable amount. Depreciable. Our student must understand, we only allocate the depreciable amount. We only allocate the depreciable amount of the non-current asset over its estimated useful life. Many assets do not depreciate to zero. Many assets don't depreciate to zero, and therefore we only allocate the portion that will depreciate. Under the matching concept, all incomes and revenues, all incomes or revenues and expenses for a particular period should be reported in the financial statements. And because depreciation is an expense of the business, therefore, it will be charged in the income statement. It will be charged in the profit and loss account or the income statement. So we're basically saying that we use depreciation is charged in line with the matching principle. Depreciation is charged in line with the matching principle, which states we match revenues with all the expenses that have helped us to generate that revenue. We match revenue with all the expenses that has helped us to generate that revenue. Any expense you incur in the course of generating the revenue, including the loss and of value of non-current assets. For instance, if we have vehicles which are transporting our goods throughout the country, the loss in value of those vehicles is an expense that year and must be matched with the revenue it has helped to generate. It must be matched with the revenue it has helped to generate. And therefore, we start by learning the causes of depreciation. We start by learning the causes of depreciation, and we have four major causes. We have four major causes of depreciation. We have four major causes of depreciation, and we start with the first one, which is physical factors. Physical factors. And we are saying the physical factors are two in number. The first one is the wear and tear. As we use the non-current assets, they wear, they lose value, As you are using it, if you have vehicles which are distributing our goods throughout the country or even throughout the region, as we use those assets, the vehicles, whatever we are using, or even the machine, as we use those machines, they lose value. So the first physical factor is wear and tear. And we're saying some non-current assets depreciate. Some non-current assets depreciate or lose value due to use over time, e.g. machinery and motor vehicles. Machinery and motor vehicles. And the second one is the rot, the decay, the rain, the wind, the rust. This happens on assets that are not well maintained by the farm, e.g. some of the machines. If you don't maintain your machines well, they will rust. They will rot. Some of the assets might even decay. You have furniture, you have put it under the rain. It will rot and it will decay. If you put your furniture under the rain, it will rot still and decay. Some of the assets may even lose value because of the wind. You know the kind of storms we are having of late, and you find some of the iron sheets have been blown off. So we are basically saying the rot, decay, rain, weed, or rust. This happens when assets are not well maintained or even taken care of by the farm. Yes, those two are the physical factors. Then we go down to economic factors. Economic factors again are two. And the first one is inadequacy. You might find that you have your factory is only able to produce about 1,000 or maybe 500,000 units. But we have now the demand for our products has blown. Instead of 500,000 units, we need about several millions. And the current factory, the current machines, they are completely inadequate for our operations. So we are forced to leave them, and we buy new machines, and we even construct new factories. That is inadequacy. It becomes inadequate it's not able to meet our demand, and therefore it's inadequate. Some assets lose value due to them becoming inadequate. E.g., when business grows or expands, then some building may become inadequate due to space, or some machines that are unable to manufacture a large number of goods. Number B is obsolescence. Obsolescence is loss in value because of technological changes, the technological changes. You find a situation whereby, especially the computers and even the phones, they are coming out every other day. You are getting new versions every other day. And you may find that the computer is still there. It is still working. It has not lost value. It is not wear and tear. It is still there. It is working. It has everything, but it's a capacity. I remember very well some times back, we had computers which were having the monitors. They were very, very, very huge, and they were a huge consumption of electricity, and they were now replaced by flat screen, which are very, very. I actually had very many of those ones which were very huge, and they were consuming a lot of electricity. I actually scrapped them. I threw them away. I used them to use them for training, but a time came and I had to actually throw them away and replace them with the flat screens. So we're talking about obsolescence. It is there. It is not spoiled, but it has been overtaken by technology. Obsolescence. Some assets become obsolete due to changes in technology or different methods of production, e.g. computers. Number 3, time factors. Some assets have a legal fixed time, e.g. property lease. Lease a house. You may lease a house for about 10 years. If you lease a house for about 10 years and you have leases for $1 million shillings, every 1 year you are losing 100,000. Every year you're losing 100,000. By the time you're coming to the 10th year, when the time is passing to the 10th year, it is of zero level. The number 4 is depletion, especially when you are doing extraction. This occurs when some assets have a wasting character due to extraction of raw materials, minerals, or oil. Such assets include mines, oil wells, and quarries. There are some places that you actually go and you have bought the asset, and you estimate the quarry will produce this number of stones, or it will produce this volume of oil, or whichever mineral it is. The more you extract, the more you lose. The original purchase value goes down. The more you extract, the more the original purchase value goes down. And therefore, we are saying you are depleting the asset. As you do the extraction, the asset is being depleted, and therefore the value of that asset is going down. Once again, like you can see in the red, please subscribe, like, share, hit our notification bell so that we can inform you every time we load this kind of videos. Now, I want us to quickly discuss about 7 methods of depreciation accounting, and the main methods of depreciation accounting that we use over and over again are 2. It is the straight line method and the reducing balance method. The straight line method and the reducing balance method. But over and above the two of them, I'm gonna touch on all the others, the other five. I'm gonna touch on the other five. Now, the straight line method, this is a method that allocates the same amount of money over the economic life of the asset. I hope you know what economic life of the asset is. It is the period we're gonna use the asset. It's the period we are going to use the asset. If we plan to use this, if you buy a motor vehicle and you want to use that motor vehicle for 5 years, the economic life of that motor vehicle is 5 years. So we are saying, under the straight line method, it's also the straight line method is also called the fixed installment method. It is called the fixed installment method because the annual charge is the same during the economic life. The annual charge is the same during the economic life. So under this method, the same amount of depreciation is charged every year over the useful life of the asset. It assumes that the asset is useful. It assumes that the asset usefulness declines evenly with the time. The asset's usefulness declines evenly with the time. The value you lose the first year is the value you lose the last year. And the way to compute depreciation, students forget residue value. Students forget residue value. And I urge you, anytime you are depreciating, computing depreciation, and we are told that there is a residue value, the value is not depreciated. The value is not depreciated. We're saying we will not lose that amount. So the annual depreciation is the cost of the asset minus residual value divided by the useful life in years. Divided by the useful life in years. We say that the useful life is the period we are going to use the asset. The useful life is the period you're going to use the asset. The cost of the asset, I say, don't assume that the original purchase cost is the cost of the asset. Go to our video on capital and revenue expenditure to learn how to determine the cost of the asset. The residue value is always given in the question. As a matter of fact, there are very many questions you may find. You are being told to determine the cost of the asset, and then you are being told the life is this period of time, and you are told to calculate depreciation based on the straight line method or based on the reducing balance method. So we are giving an illustration. If a machine costs $100,000 US and has a residue value of 10,000 with a useful life of 9 years, meaning we will not lose 100,000 when you use it. We will only lose 90,000. The value that we will use is 100,000 minus 10,000, we get 90,000. The 10,000 that remains will be sold and we will be able to recover that money. So depreciation will be 10,000, the original purchase cost, minus the amount that is remaining after usage, 10,000. We are left with 90,000, and 90,000 divided by 9, you get 10,000. And therefore, every year we charge 10,000. And that's what they were saying. You may find a question that is asking you, this method is suitable for what kind of assets? And you're saying it is suitable for buildings, for furniture, and other assets that give uniform service throughout their life. The service does not decline. The service does not decline. But you can, as you can realize, it may not be very good for motor vehicles because the older they become, the lesser they are able to be efficient. Number two, we have the reducing balance method. It is also called the diminishing balance method. The diminishing balance method. Students, I don't understand why they think that this method is difficult. This is one of the simplest methods because always in any exam question, you are given, when you go to the trial balance, you will get the original purchase cost of the asset and you will also get the accumulated depreciation for the asset. Now, once you get that in the trial balance, the original purchase cost of the asset and the accumulated depreciation of the asset, and you are told to compute depreciation based on the reduced balance method, you need to get the original purchase cost and the accumulated depreciation, because they are telling you in that question that this is the depreciation from the date we purchased up to the beginning of the year. Up to the beginning of the year. So you get the net book value at the beginning of the year. How do you get the net book value at the beginning of the year? You get the original purchase cost, you subtract the accumulated depreciation given in the question. You have a trial balance, and it will have the original purchase cost and the accumulated depreciation. That is the depreciation from original purchase, the day of purchase, to the beginning of the current year. So you get the original purchase cost, you subtract the accumulated depreciation, you get the net book value at the beginning of the year. Now you get that net book value and you apply the rate given. You apply the depreciation rate given. The more you spend, the more you use the asset, the lesser the net book value, because the more the accumulated depreciation. And therefore, because the lesser the net book value, the lesser the depreciation charge over the years. The lesser the depreciation charge over the years. So we are charging more at the beginning and less over the years. And less over the years. So you're saying depreciation is charged at a fixed percentage rate on the net book value. Please mark that. The rate is fixed, but we are charging it on the net book value. So the net book value, the first year, we charge depreciation without deducting anything. The second year, we charge depreciation based on the net book value, original purchase cost minus depreciation for the first year. The third year, original purchase cost minus depreciation for the first year and second year. The fourth year, the original purchase cost minus depreciation charge for the first, second, and third year. So the depreciation charge will go down over the years based on the previous depreciations. So we are saying the asset each year, we are saying that the cost less accumulated depreciation of the asset each year. Thus, the depreciation amount reduces over time. The amount you are charging depreciates or goes down from one year to the other. It goes down from one year to the other. And you are saying this is our formula. Depreciation for the year is the book value at the beginning of the year. From the trial balance, you get the purchase cost minus accumulated depreciation at the beginning of the year, you get the net book value. This should be the net book value. The net book value. The net book value at the beginning of the year. And you subtract, you multiply by the depreciation rate. And therefore, the lesser the net book value, the lower the depreciation. This one will continue going down. So when you multiply it with the depreciation, the first years the depreciation is high, but as the years go by, the depreciation goes down. And we are giving ourselves an example. You're saying if an asset costs 50,000 and the depreciation rate is 20%, year one it is 50,000. It is 50,000 times 20%. You get 10,000. But year two, you subtract, you get 50,000 minus depreciation for the first year, 10,000. 50,000 minus depreciation for the first year, 10,000. So at the beginning of year two, the net book value is 40,000. 40,000 times 20%, you get 80,000. Now year three, now you will need to get the depreciation for year one and year two. Year one is 10, year two is 18,000. So it's 50,000 minus 18,000. You get the net book value now at the beginning of year three, and you multiply by 20% to get the depreciation charge for year three. That is 6,400. And you continue doing that. You continue doing that. And we are saying this is a method is suitable for machinery, motor vehicles, and equipment that lose value more quickly in the early years due to wear and tear or obsolescence. Number three, sum of digits. So the most applicable, for students doing ATD1 and quite a bit of it ATD2, the two methods, the street rate method and the reduced balance methods are the most frequently tested areas. But you will find the CPA students being asked about the other methods. It's good to learn them. It's good to learn them. So number three, sum of the years digits method. Sum of the years digit method. We are saying that this is an accelerated. It's actually another one reduced balance method. You charge a lot at the beginning and very few during the latter years. This is an accelerated depreciation method where higher depreciation is charged in the early years and smaller amounts the latter years. A smaller amount the latter years. The total number of years digits is used to determine the proportion of depreciation for the year. If it is 5 years, you say 5 plus 4 plus 3 plus 2 plus 1. You get the sum of that's why the method is called the sum of years digits. So if it is 5 years, you say 5 plus 4 plus 3 plus 2 plus 1. You get the denominator, sum of the years digits. You get the remaining life of saying for a 5-year asset, sum of the digits is 5 plus 4. I have said it is 15. If the cost of the asset is 30,000 and the residual value is 0, then for the first year, the first year we get 5 divided by 15. 15 is the sum of the digits, sum of the digits, sum of the digits, sum of the digits. 5 years. The first year you say 5, the second year you say 4, second year you say 3. You go all the way until you get the first year. So you can see the first year you have a 5 divided by 15 of 30,000, you get 10,000. Year 2, 4 divided by 15 divided times 30,000, you get 8. Year 3, 3 divided by 15 times 30,000, you get 6,000. So that's the way we go on sum of digits method. This is again suitable for assets that decline in efficiency rapidly, like vehicles and computers. Number 4, units of production method. It's also called usage or activity method. You ask yourself, how many units do we expect to produce with this machine? How many units do we expect to produce with this machine? So if we expect to produce 1 million units and it is it's worth 2 million shillings, it therefore means you get the 2 million, you divide by the number of units you expect to produce with this machine, which is 1 million, and therefore for every unit we produce, we subtract 2 shillings as depreciation expense. And that's what we are being told here. Depreciation is based on the actual usage. Depreciation is based on the actual usage or output of the asset rather than time. It assumes that the wear and tear depends on usage, not how long the asset is held. And the formula is depreciation per unit is the cost, the original purchase cost of the asset minus residual value divided by total estimated units of output. That one you are getting depreciation per unit. You get depreciation per unit by getting cost minus residual value, cost minus residual value divided by total estimated units of the output. So for every unit, you know how much you are losing in terms of value. So if you're not producing, we are assuming you're not losing value. But the more you use the machine, the more you are losing value. And therefore, at the end of the year, you get the number of units you have produced, you multiply by depreciation per unit, to get the annual depreciation expense. I want to repeat again. This method assumes that we charge depreciation of the asset. We buy a machine for factory, for production, and we estimate that this machine will give us 1 million units, and we bought it at 2 million shillings. Therefore, you get the 2 million shillings, you divide by the units we produce, that is 1 million, and therefore every time we produce a unit, we are losing 2 shillings. And therefore, you apportion it based on the number of units that we have produced. And we're saying an example, a machine costing 100,000 pounds, US dollars, residual value is 10,000, expected to produce 90,000 units. Therefore, depreciation per unit, we don't charge depreciation for the residual value. So it is 100,000 minus 10,000 residual value, you get 90,000. You divide it by units, you are going to produce 90,000, and therefore every 1 unit you are producing, you are losing £1, one US dollar. You are losing $1 US. If you produce 20,000, you will definitely depreciate 20,000 times $1 to get 20,000 shillings dollars as the depreciation charge. This is suitable for mines, oil wells, manufacturing machines, and other assets where output can be measured. Another similar one, but this time it's not based on the output, it is based on the number of hours we are using the machine. It's based on the hours we are using the machine. It is called machine hour rate method. Machine hour rate method. And how do we explain the machine hour rate method? We are saying depreciation is based on the number of hours the machine is used. each hour of operation bears an equal portion of the total depreciation. We are saying you can buy a factory machine, and we know that this factory machine may be used for 2 million hours. It may be used for 2 million hours, and therefore we are asking ourselves, the more we use it, the more it is losing value. So if we bought it at 20 million, and we can only use it for 2 million hours, and we have already used it for 1 million hours, it means half of the value is already used up. And the formula is as given below. The formula is as given below. Depreciation per hour is equal to the cost minus residue value to get the depreciable amount. Then you divide by the total estimated working hours to get the depreciation per hour. To get the depreciation per hour. The depreciable amount, which is cost minus residue value, you divide by the total estimated working hours to get depreciation per hour, and therefore you get the number of hours used. You multiply by depreciation per hour to get the annual depreciation. And here we are told, as an example, is a machine costing $60,000, residue value is 6,000, and is expected to run for 18,000 hours. So depreciation per hour is 60,000 minus residue value. We're getting the depreciable amount. 60,000 minus 6,000, we get the amount that can be depreciated. We are saying that 6,000 is not depreciable. So 60,000 minus the residue value, we get the depreciable amount. That is 54,000. And then you divide with the machine hours of 18,000 to get the depreciation per machine hour, which is $3, per hour. Now, if we used 4,000 hours, if this year we use 4,000 hours, then we get 4,000 times 3, we get $12,000 as our depreciation expense. It is suitable for machines used intermittently. They are not being used daily. They are not being used on a continuous basis, the same number of hours every day, or with varying workloads in manufacturing. Number 6, we talk about the revaluation method. And this is usually applicable when we deal with livestock, tools, loose equipment, or assets whose individual costs are small and frequently change in value. The value is small. The value per tool is small. For instance, I like saying things like spanners. You may be having in a huge factory, you may be having very, very many spanners and the other tools. So what you're saying is, we do revaluation on an annual basis. Instead of going to value a small item, one after the other one, and one after the other one, and the value is very small, it may not be economical to do that. But what you do is to look at them and make an objective valuation. So we are saying under this method, the asset is revalued at the end of each accounting period, and the difference between the book value and the new value is treated as depreciation. And therefore we are saying the book value at the beginning minus the revalued amount at the end, you get the depreciation expense. If an asset's book value at the beginning of the year is 50,000 and it's revalued at the end of the year to 45,000, then depreciation is 5,000. This question simplifies the case, but you can have a situation whereby we are saying the value at the beginning of the year was 50,000 and we bought assets worth 20,000. And the value at the end of the year is 60,000. The value at the beginning was 50. We bought assets worth 20,000, therefore it got to 70. But the value we are making is not 70, the value is 60, meaning the depreciation of the loss in value is 10. And I think I explained where they can be comfortably used. Now, finally, the method of depreciation method. And this one is usually used when you're dealing with natural resources, such as mines, oil wells, quarries, timber forests. Depreciation is based on the amount of resources extracted during the year. We estimate the total amount of resources we that are available, we estimate the total amount of resources that are available, and then we get the residual value and divide with the estimated resources available, the number of units available. We get the depreciation per unit. Now, after you have done the extraction, you therefore get the units extracted in the year using this formula, and then you get the depreciation per unit, and you get yourself the depreciation expense for the year. You get the depreciation expense for the year. Now, we are saying, we are giving ourselves an example. An oil field costs 10 million, residue value is 1 million, and is expected to have an output of 900,000 barrels. Depreciation per barrel is definitely the 10 million, the original purchase cost, the 10 million, you subtract the 1 million, which is the residue value, to get a depreciable amount, and then you divide by the number of units you expect to produce to get $10 per barrel. And therefore, you now get the number of barrels you have produced. If 100,000 barrels are extracted this year, you get the depreciation is 100,000 times 10, which gives us 1 million as our depreciation expense. Like you say, this is suitable for mines, quarries, oil wells, and other wasting assets that are depleted through extraction. We urge you to please subscribe, like, share, and hit the notification bell. That is the only way we are going to inform you when we load this kind of very, very important videos. And I want to repeat again, anytime you are doing a computational exam, you must always remember that theory can save a man. Theory can save a man. Many times we ignore theory. And you find a question has 20 marks, and there is a theory within that question of 8 marks. It means you are doing that particular question out of 12 marks if you don't know, if you can't answer the theory. So be sensitive. Remember to read the theory questions. Thank you very much. See you in our next video. Please listen to our video on I have 2 videos I want you to listen to. Listen the video on capital and revenue expenditure, and listen to the video on 15 reasons why we charge depreciation. 15 reasons why we charge depreciation. Those 3 videos are tied up. And I'm going to do now another one that will show completing depreciation, how we do acquisition, how we do disposal, how we do trading, and even how we prepare the property, plant, and equipment movement schedule. Now, all these videos help you to understand the concept of depreciation in a very, very comprehensive manner. Thank you very much.